feel it's appropriate to read the Oversight and Government Reform's mission statement. We exist to secure two fundamental principles. First, Americans have a right to know that the money Washington takes from them is well spent. And second, Americans deserve an efficient, effective government that works for them. Our duty on the Oversight and Government Reform Committee is to protect these rights. Our solemn responsibility is to hold government accountable to taxpayers, because taxpayers have a right to know what they get from their government. We will work tirelessly in partnership with citizen watchdogs to deliver the facts to the American people and bring genuine reform to the Federal bureaucracy. This is the mission of the Oversight and Government Reform Committee. I now recognize myself for 3 minutes for an opening statement. Today we examine the rule writing of Section 941 of the Dodd-Frank Act, which mandates Federal regulators promulgate rules requiring entities to retain a certain amount of risk on securitized assets. We will compare the rules of risk retention and its special exemptions to policies and rules that would ensure adequate transparency and standardization under Section 942 of the Dodd-Frank Act, which requires the SEC to modify Regulation AB to include loan-level disclosure. The focus of this comparison is to examine the effect that transparency and risk retention have on the market. Most importantly, how does each influence the availability and cost of credit to borrowers and small businesses? As Federal agencies issue rules and announce comment periods, risk retention has become hotly debated. I appreciate the intention of requiring a little skin in the game, as we'll say, the theory being that if an issuer retains a piece of the ongoing responsibility for the loans that they write, they have an incentive to make better loans and price them appropriately. However, like all government rules and mandates, there are exemptions which provided for certain entities. To begin with, Dodd-Frank exempts FHA from risk retention requirements. It holds this coveted advantage in the marketplace due to the full backing of the U.S. taxpayer. However, Dodd-Frank does not impose the restrictions on FHA's underwriting standards, moving the agency into a position of accepting lower qualified mortgages, more or less appearing to defeat the stated intention that this administration has said to reduce taxpayer exposure to the housing market. In addition to exempting FHA, the QRM rulemaking does not permit private mortgage insurance to compensate for lower down payments. I've got concerns about this. This raises the concern that we're driving out prudently underwritten, low down payment option mortgages, particularly for first-time home buyers, which I think further exacerbates the imbalance between the private market and FHA lending. Secondly, Fannie Mae and Freddie Mac are exempted under the proposed risk retention rule, which runs contrary to the language laid out in the Dodd-Frank Act. And before anyone forgets, Fannie and Freddie, this exemption appears to go against the administration's proposal, the broad proposal that they have to reform Fannie and Freddie and wind down the GSEs. Well, third, there is no secret that risk retention favors large, well-capitalized banks as compared to smaller, less capitalized banks. Only the largest financial institutions have the balance sheet to retain for extended periods the 5% of all securitization they complete. This leaves one to ask the question, how will risk retention rules affect the operations and competitiveness of our community and small banks and small businesses that access their loans through those institutions? In addition, today's hearing gives us an opportunity to gauge the value of risk retention and loan level disclosures and how government can push forward policies to open up our capital markets without opening the floodgates of unintended consequences. One thing is for certain, our families and businesses cannot afford overreaching government policies that increase the cost of credit and stifle economic growth. It's an imperative that our rules and regulations enable the market to appropriately price the cost of capital to our families and small businesses while recognizing the importance of private capital in the housing sector. I look forward to our panel's testimony, and with that I recognize Mr. Quigley for 4 minutes.